I will start the presentation. Myself, Professor Asha Prasuna from Somaiya Management Institute, Bombay. And my co-authors are Professor S.N.V. Siva Kumar from Department of Economics, Somaiya Management Institute, and Dr. Keshab Bhattarai from University of Hull. So now my presentation is on comprehensive risk assessment model for pre-mergers and acquisitions. So the topics, flow of the presentation is first I talk about introduction, then select review of literature, my research questions and methodology, data and analysis, discussion conclusions, managerial implications and the limitations. And this is a part of one of our PhD research scholars work, which we have actually created a model with where we tested this model also, and we are going to implement it. We filed a patent and we published a patent on this M&A risk scoring model also. So that is a background of our research work. So broadly, it talks about, it comes under the domain of corporate finance, mergers and acquisitions. All of us understand the basic concept. It is an inorganic growth for a company to expand. And then this has become a strategy, corporate strategy for continuity, business continuity, as well as, facing the challenging situations. So if you look at the number of deals that have been done during this pre-COVID period, say for instance, 2017 to 19, globally, there were almost, 50,000 deals per year were happening. And during the pandemic, we had little bit of fall in terms of the number of deals. But however, we can notice that people have quickly adopted to the new ways of handling the businesses and addressing these uncertainties. So the deal values have increased by 46% higher than 2020 and 67% higher than 2019 levels, reaching to $4.3 trillion. So in the beginning of this year also, 2022 also, we had almost 60,000 publicly disclosed deals breaking the mark of US $5 trillion also for the first time. So post-COVID, we have seen a lot of developments in terms of M&As overall also. However, there was a small decline in the deal value. So that is a just of the numbers in terms of global M&A that are happening. So in the context of this M&A research, what we found was actually a lot of information, lot of valuation models, and then failures and success factors for each of these deals have been done extensively from the past 30 years. However, our research focused on whether we can have a holistic model which will help the company or the corporate top management to assess the risks before getting into the deal. Of course, the financial, legal, due diligence, all these will happen, but can we have come out with a certain model which will comprehensively assess the risk, before the deal happens, so that we can calibrate on those risks and try to increase the probability of success. So that is the context where we did this model and tried to carry out this research. So the contribution of our research is like the first one talks in terms of adding financial and non-financial factors together in assessing this M&A risk. Earlier, what used to happen is a lot of studies just focus on HR factors, technology factors, financial factors, market capitalization, things like that, to assess the success and failure of a deal. Similarly, some studies also looked at non-financial factors in terms of, say, technology or leadership, HR factors, cultural integration, all those things also some people have looked at. So our model talks about adding both together and creating a holistic model. That is the first contribution we plan to do for the existing research. And then further, what we did is we tried to categorize the M&A risks. What are those, 5 important types of risk any deal will have? And after identifying these major categories of risk, we tried to assess these risks and estimated a model using structural equation model, wherein we tried to estimate the probability of the success of that particular deal. So the select literature review starting from 1980, which is an OFDI theoretical models and concepts also, in terms of what are the determinants of M&A synergy theories, and then there are a lot of theoretical literature was reviewed, and the recent studies also we tried to see applying the SEM models, applying the latest techniques, and also how do we try to study a particular deal holistically, assess the risk of that particular deal. So what is our model talking about is we tried to construct 2-level nested model where we took 5 factors, 5 important risks we identified. One is financial risk, management and human resource risk, technology risk, geographical risk, and macroeconomic risk. So risk at each level of each firm we can estimate by trying to track the volatility of these factors, which are some numbers we have and some are unobservable and qualitative things also, like management change or cultural shift or the technological integration. They are all qualitative numbers. So we try to capture all these things, both data, quantitative and qualitative numbers, and we try to explain what are these the observable and non-observable risks that will have a impact on that particular deal. So we have actually used the Indian data of 150 mergers and acquisitions deals that happened during the 2005 to 2019. We have taken the deals, and then we created this particular model. And this is very comprehensive, and the results, we can easily implement and then make use of it also. So that is about our model. Now, going forward about the methodology, the questions we asked are, what are those 5 key risk factors or key risk drivers are there? And how are we going to address? How are we going to measure those risks? And once we measure these risks, is there any possibility of intervening mechanism to reduce these risks? First is measurement, and second is addressing the reduction of the risk. So this is what is our research questions are. And what we followed is SEM model in terms of methodology, structural equation model. And as far as data is concerned, first we looked at all the secondary data, published data from 2004 to 2020. Then we also supplemented those results, macro results basically, with the micro level of deal level sample size. We took 150 deals that took place, and we have carried out the survey questionnaire to the actual M&A professionals. And then that results were captured and analyzed, and we came out with this particular model. So what are our hypotheses? As I said, these 5 hypotheses based on those 5 risks: financial, technology risk, management risk, geographical risk, and macroeconomic risk. We formulated these 5 hypotheses, whether these 5 risks have an impact on the probability of success or not. And can we quantify that also, so that we can fine tune the take certain policy and try to reduce the probability of failure and increase the probability of success. That was our main goal. So as I said, financial risk was captured by all these finance data and numbers in terms of EV, EBITDA, valuation parameters, current profit and loss, deal value. And there are 7 each of these 5 types of risks have different sub-factors, which will help us to measure these risks. So financial risk has X11 to X17. Similarly, technology risk has X21 to X29. 9 factors, where current technology, new technology, adaptability, R&D, replacement cost, all these factors, we took it as a drivers basically. So we can give them and rank them. And based on that, we arrive at a scores. The third point is, third risk we are calling management leadership. Whether after the deal, leadership has changed, or there are any strategic changes have happened, compensation changes happened, process sync is there or not, integration policies, cultural sync, we have taken it in terms of the management factors. Then geographical factors we took, whether this particular deal structure is aimed at tax-related synergy or regulatory incentives or market seeking or entering into new geography. So there are 5 factors which will tell me what is the geographical risk. And of course, macroeconomic risk, the usual indicators, economic indicators of growth, inflation, interest rates, exchange rate, industries, policies, government policies, all these things, we have taken 7 factors as a macroeconomic risk factors. So once we identified this particular 5 at a broader level, 5 types of risk, and within each risk we have certain factors. ranging from 1 to 5, 1 to 7, 1 to 9, 1 to 1 to 7, 1 to 9. So this becomes our first specification of our nested model. Then comes our the next thing is we try to work on the solution for this particular model using the SEM matrix. So this is what we are getting the solution. And once we get the solution, we try to estimate these direct and indirect effects, which can be, which I mentioned in the matrix form, same thing in a diagrammatic form. So while doing this, what we have finally found out was the estimated model gave us some data points and numbers basically in terms of composite economic factor. If economic factor is, economic risk is there, which can be decomposed into the 7 sub-factors. And these are all, the estimates, the latent estimates of economic risk. And similarly, this is the estimates of financial risks. And the next slide talks about estimation of geographical risk. Then we have estimation of human resource factors, that is management leadership risk. So like this, we were able to try to come out with some quantitative composite risk factors, risk numbers basically, which will add up to the total risk. As we can see in this particular graph, I have all these 5 risks coming in and we can estimate the total model basically. So this is how the histographic representation of all these risks. And now coming to my conclusions, actually, when we have estimated this score, total score, finance risk is contributing 0.44, technology 0.45, management and HR 0.35.
Dr. Basha, can you mute yourself? Thank you.
1 minute.
Sorry, carry on. No, Dr. Basha, I was asking him to mute himself because he was talking. Carry on, Dr. Asha.
Yeah. See, what I was saying is all these risk factors were taken into account and we estimated that model, which gives me the risk basically. How much is a quantifiable finance risk, technology risk, management risk, geographical and macroeconomic risk. So once I get this particular risk, I will have some score in the scale of 0 to 100. So what I can say is I can allocate the scores based on these particular grades. Suppose if a deal has a score of 71 and above, I can give them rating as AAA. Then similarly, 60 to 64, then triple B, and 50 to 54, triple C, I can grade them. So how does it is going to help me is this grading system. Suppose in all these 150 deals, what we have done, some deals are falling under say 50-54 range, or some deals are getting a score of 65 to 70. 71 and above, we can go ahead with the deal. And then if you get some scores below 50 or 55 sort of a thing, we can see where we are lagging behind or which risk is more. So accordingly, I can fine tune my deal process and try to achieve a higher level of success. So that is the contribution, that is the crux of this our model. So what we did is finally the research questions, how did we answer? The first research question is what are the risk drivers? We identified the risk. Second is how are we addressing these risks? So we have divided into sub-factors and we try to create some weighted, try to allocate some weights for each of these sub-factors, which will add up and give me the maximum score in that particular risk category. Accordingly, we have arrived at the total scores for each of these deals. And then what is the intervening mechanism? Based on these my scores, like as we have a credit rating and then country risk rating models and all, similarly, this M&A rating model we are calling. So this rating will help the top management or the CFO or the strategy person, M&A strategy person, to understand where he is falling, in which risk is high, and accordingly he can fine tune his deal and try to renegotiate the deal or make changes in that. So to conclude, we found through this particular exercise, 69% of the aggregate risk is transmitted because of the geographical factors. Okay. So corporations should look at that particular geographical factors, how they are going to help with the success of the deal. And second important factor turned out to be 56% is macroeconomic risk factors, and technology is transmitting 45%, financial factors are 44%, HR, management, culture, all those are adding to 35% of the aggregate deal. So what we are trying to say is whether we can use this risk assessment model for all the deals going forward, so that we will have, like, in that research or the current lot of people argue in terms of what are the success factors in the percentage of success in the M&A deals, why that short run success only is there, the long run sustainability of deals is not happening. So we can answer some of those questions using this particular model. If we go wrong on assessment of the deal before happening only, then the probability of success will be less. That is what we can conclude, and we can use it in the policy space also, and limited global as well as India, but India related deals only we have used. We can extend that for the other deals also. And to summarize, our study is in terms of the creating this model, risk assessment model for the M&A practitioners. And we have also used this in the current situation with large corporates, and in Indian context with CFOs also we have given. And we also created a web-based tool to estimate this particular model using the, say, Python, and some small algorithm is written. So this contribution can be reaffirmed by the industry once they start using the model. So this is from me. Thank you so much for giving us this opportunity.